I think what we saw at the tail end of last year was sort of calls or an early lead that cuts might come, but then we got 3 consecutive months of upside surprises to inflation, and we were communicated that actually we had to call for patience on those cuts, and so that looks like a decent benchmark, a timeline for a trend to appear. And so what we've seen is now 3 consecutive months of encouraging surprises on inflation. And so maybe a timeline has been hit here, that a trend has emerged, that inflation is moving lower again. And so on that basis, I think the Federal Reserve is likely to tee the markets up for a September rate cut, and no doubt another one this year as well. So I think markets on balance, you think, would sort of take some encouragement from that. Of course, we're seeing a bit of short-term noise in relation to a soft landing and a virulent recovery that's in sort of engendering small cap performance. But on balance, I think these are the sort of reports that markets are looking for.
Okay, so that Q3 cut looks to be firming up, and as I said earlier, now a 90% chance of a September move here. So let's see what the messaging looks like from the Fed. In the meantime, Ben, what does it mean for your investment strategy here? I know you have a preference for US and UK equities, positive to modestly overweight here. How do you want to be allocating in this environment if indeed that cut does come through in September?
Well, it's an interesting one that our preference for sort of US equities, large cap US equities, you might associate with performing better under a rate cutting environment. That sort of duration relationship, high quality growth does better in, as I say, with accompanied by rate cuts. But we've got this sort of conflicting view from markets, certainly overnight, that you might see an impressive recovery if you get enough rate cuts, and that's fueling sort of small cap US small cap performance. We would caution against that. It's certainly possible, and we do have that sort of hedged in portfolios, but we're leaning into still large cap US growth. We think there could yet be data that calls for patience on the speed of rate cuts. Of course, rates still remain very high, that continue to bite into the economy. So we want to be cautious of the risk of recession. Certainly that growth could be moribund and pretty low for an extended period here. So on that basis, high quality US growth remains a reasonable place to be leaning into. But look, if inflation sort of falls fast enough and job growth remains, or the labour market remains strong, then the recovery could start to look more impressive. We might have to think about moving away from US growth into more riskier assets, such as small caps, such as value markets, and maybe some EM as well.